So, good afternoon. Today is our last session. We will be doing a very important chapter, International Financial Management today. Your chapter 11, International Financial Management. In this, we would be looking at various models. First, we will look at international capital budgeting. We started our session, the first session, with advanced capital budgeting decisions. And today, instead of looking at a domestic investment, if we invest in another country, what is it? We will consider. That is what we are going to see. The principles are the same, except another foreign currency is involved. So we will see how to go about it. Now, first of all, any capital investment decision is based on three principles. One, benefit cost analysis. Two, the benefit and the cost has to be measured using cash flows. The benefit and the cost has to be measured using cash flows. Then the time value of money has to be incorporated. These are the three principles which we are looking at. So any investment decision, there are three principles which we consider. What are they? One, before taking a decision, we have to look at benefit and cost. We need to make a benefit cost analysis. Then the benefit and cost must be measured by means of cash flows. And then third, we have to incorporate time value of money in our capital investment appraisal. So time value of money will be incorporated by discounting the cash flows. For evaluating a capital investment proposal, we have to consider three things. The cash outflow, which is our investment. The cash inflow, which is our return. The discount rate, which incorporates cost and risk. And this is how we incorporate the time value of money. We said benefit cost analysis. What is the benefit? The cash inflow. What is the cost? The cash outflow. That is my investment. Then discount rate would consider the cost, risk adjusted cost. So cost and risk. The required rate of return is used as the discount rate. It is the risk adjusted discount rate. Already in our first session, when we did advanced capital budgeting decisions, that time itself, we discussed the required rate of return consists of three components. One, real risk-free rate. That is a sacrifice for present consumption. Two, inflation component. This is the compensation for loss of purchasing power. And three, risk premium, which is a compensation for the risk taken. The nominal risk-free rate is real risk-free rate that incorporates inflation. The real risk-free rate is the nominal risk-free rate after stripping it off the inflation component. So, while evaluating domestic capital investments, cash outflow and cash inflow will be in domestic currency. The discount rate applicable is a domestic discount rate. On the other hand, while evaluating international capital investment, cash outflow and cash inflow will be in foreign currency. The nature of the cash flow, we know this, the nature of the cash flow will determine the nature of the discount rate. The nature and the timing of the cash flow will determine the nature and timing of the discount rate. So, foreign currency cash flows should be discounted using foreign risk-adjusted discount rate. The foreign risk-adjusted discount rate and the domestic risk-adjusted discount rate, will they be different means? Yes, they will be different. Why? Because the nominal risk-free rate will not be the same in two countries. What do we take as the nominal risk-free rate? The rate of return on government securities is what we take as a nominal risk. Now, when we say that the return on government securities is what we take as the nominal risk-free rate, the return on government securities in different countries will be different. Therefore, we cannot have the same discount rate. We cannot have the same nominal risk-free rate. Then the project risk premium, what we have to take, that varies with projects. It depends on the riskiness attached to the different projects. The risk attached to a project depends on the nature of the project and the industry. Now, for evaluating capital investment, international capital investment, there are two approaches. One is foreign currency approach. Two, domestic currency approach. What is foreign currency approach? Under foreign currency approach, foreign currency cash flows are discounted using foreign risk-adjusted discount rate to find foreign currency net present value. This foreign currency net present value is then converted into domestic currency. This is what it is. Now, foreign currency approach means foreign currency cash flows are discounted using foreign risk-adjusted discount rate, and then ultimately we want it as net present value in whatever is our currency. Therefore, that net present value which we have in the foreign currency will be converted into domestic currency. How will we go about it? We need to find the risk premium for the project. How will we find this? We will have the domestic risk-adjusted discount rate. Now, this domestic risk-adjusted discount rate, which we have domestic risk-free rate also. Domestic risk-adjusted discount rate is there. Domestic risk-free rate is there. With these two, we can consider the project risk premium. Next, what we should do? Foreign risk-adjusted discount rate. Now, for foreign risk-adjusted discount rate, we need foreign risk-free rate. So we will take the foreign risk-free rate. The risk premium which we found, together we will have the foreign risk-adjusted discount rate. Then foreign risk-adjusted discount rate will be used to discount foreign currency cash flow. With this, we will find foreign currency net present value. Then we will convert the foreign currency net present value to domestic currency. At what rate? Now, what we have is net present value. So what rate should we take? We should take the spot rate. So for finding net present value, spot rate should be used. Then our usual story, if net present value is positive, accept it. Otherwise, reject it. So this is foreign currency approach. Now, the problem will indicate or will clearly specify whether we should follow domestic currency approach or foreign currency approach. Either they will clearly mention using foreign currency approach, or they will say using domestic currency approach. Alternatively, they may indicate as to which one we have to take. If both are possible and the problem does not specify, then you are free to choose whichever is easier for you. So foreign currency approach, is it clear? What do we know? What should we do in foreign currency approach? We will find risk premium for the project by taking domestic risk-free rate and project, whatever is the risk-adjusted discount rate. How will I find that? 1 plus domestic risk-free rate multiplied by 1 plus project risk premium is equal to 1 plus domestic risk-adjusted discount rate. So with this, what we should do? We have found the risk premium. Now we are using a foreign currency approach. Foreign risk-free rate, we will consider project risk premium, which we already found, 1 plus foreign risk-free rate multiplied by 1 plus project risk premium. That will give us 1 plus foreign risk-adjusted discount rate. This foreign risk-adjusted discount rate which we have, we need to use it to discount foreign currency cash flows. Then we have the foreign currency cash flows. We have the foreign risk-adjusted discount rate. Therefore, we can find net present value in foreign currency. But we wanted our domestic currency. So we will apply the spot rate. Is it okay to apply the spot rate? Means perfectly fine. That is what you should do. Because what you have is the present value. Present. Now, therefore, spot rate will be used. Then our usual story. What is the selection criteria? Net present value is positive, accept. Net present value is negative, reject. Next, domestic currency approach. Now, under this approach, what will we do? See, the nature of the cash flow will determine the nature of the discount rate. Cash flows are real, discount rate real. Cash flows are nominal, discount rate nominal. Cash flows are foreign currency, discount rate foreign. Cash flows are domestic currency, discount rate domestic. Cash flows are from equity perspective, discount rate cost of equity. Cash flows are from long-term fund perspective, discount rate weighted average cost of capital. So the nature and the timing of the cash flow will determine the nature and the timing of the discount rate. Now, domestic currency approach. What you should do? Domestic currency cash flows are discounted using domestic risk-adjusted discount rate. What will we do? We will convert foreign currency cash flows into domestic currency cash flows using exchange rates. How will we use exchange rate? If actual forward rate is given in the problem, we will take. Because the cash inflows are going to arise in future. So, if actual forward rates are given, we will take it, we will apply it. If interest rates are given, then we will find the expected or theoretical forward rate using interest rate parity theory. The interest rate considered in interest rate parity theory is money market interest rate. That is what we will consider. Or supposing actually forward rate is also not given. Interest rates are also not given. If interest rates are given, I can use interest rate parity and find the theoretical or the expected forward rate. Supposing inflation rates are given, then I will use purchasing power parity and find the expected spot rate. If both inflation rates are given and interest rates are given, then I necessarily should go with interest rate parity. So the risk of the project should be incorporated while discounting the project cash flows. Why? Because we already saw what we have is the money market rate, which is a risk-free rate. And therefore, now what we have is a risk-free rate, and we need to employ the risk premium, which we have, and we need to take. I will use the risk-adjusted discount rate to discount domestic currency cash flows. Then I will find net present value in domestic currency. As it is in domestic currency. So I need not worry about it. Now, if I look at the problem, nothing is mentioned. The assumption is that the domestic or foreign currency cash flows given in the problem are nominal cash flows unless otherwise specified. Any cash flow, any interest rate, what they have given should be assumed to be nominal unless they have clearly mentioned that it is real. Next, the discount rate given the problem is also nominal unless otherwise mentioned. So, domestic currency cash flow, nominal. Foreign currency cash flow, nominal. Discount rate, nominal. This should be the normal assumption unless it is given otherwise. Then, domestic currency approach should be employed unless otherwise required by the problem. Normally, anyway, we want only in domestic currency. Therefore, domestic currency approach should be employed. Now, nominal approach should be employed unless otherwise required by the problem. If cash flows are in domestic as well as foreign currency, then also we should follow only domestic currency approach. Ultimately, we want everything in domestic currency. Therefore, if both are there, you would much rather prefer straight away doing it. There is no point in converting a domestic currency which we have to foreign currency. Foreign currency can be converted into domestic currency because ultimately, finally, we want everything in domestic currency. Are you clear with these things? What do we know? Whether it's a domestic currency cash flow or it is a foreign currency cash flow, what is given in the problem is nominal cash flow. Similarly, what is given in the problem is nominal discount rate. That is, these are the assumptions we will make unless otherwise specified. Specifically, it is given real cash flows are taken, then we won't take it as nominal. If nothing is mentioned, simply they have given cash flow, then it means it is nominal. So, what do we know? The domestic currency cash flows given are nominal. The foreign currency cash flows given are nominal. The discount rates given in the problem are nominal. Domestic currency approach should be employed unless otherwise required by the problem. So, foreign currency cash flow means they should have mentioned it. Then, if nothing is mentioned, again, nominal approach only should be applied. Then cash flows, if you have mixed up, domestic is there, foreign is there, then also we will follow only domestic currency approach. So predominantly we would be following domestic currency approach. Rarely we will go for foreign currency approach only when specifically required by the problem. So up to this, are you okay? Is it clear? Are you ready to take up a problem? Till this, okay. Only some slight adjustments, small variations when we look at this approach. Okay, ready? Fine. Now let's take the problem. This is the problem we have to do. Assuming that you are the finance manager of XYZ Limited, calculate the net present value and modified internal rate of return of the proposal. You have to find net present value and you have to find modified internal rate of return. So first of all, what is internal rate of return? What is modified internal rate of return? Sorry. Yes. What is internal rate of return? What is modified internal rate of return? Other names for internal rate of return, we know economic rate of return, discounted cash flow return. These are other names for internal rate of return. What is internal rate of return? Now, normally, it is stated internal rate of return means the rate at which NPV is 0. That is computing how will you find internal rate of return? That is all. That doesn't mean that is the definition or explanation or meaning of internal rate of return. Yes. Internal rate of return is the expected annualized compounded rate of return of an investment proposal over its life. Internal rate of return is the expected annualized compounded rate of return of an investment proposal over its life. Now, how will I identify what is the internal rate of return? How will I ascertain that a particular rate is an internal rate of return? That I will say it is a rate at which, when used to discount the cash flows, results in the present value of cash inflows being equal to the present value of cash outflows. So what is my selection criteria? We already see. First thing we saw today, as well as in the first class, when we did advanced capital budgeting decision. What is it we saw? That there are three principles when we do any investment. What are the three principles we are looking at? First, benefit cost analysis. And then what is it we look at? The benefit and the cost has to be measured in terms of cash flows. Then time value of money should be incorporated. So benefit cost. The proposal will be selected if IRR is greater than cost of capital, required of return. Now, why do we call it internal rate of return? The term internal refers to the fact that the rate of return computed is the return internally generated by the proposal. It excludes external factors such as what? Real risk-free rate, inflation rate, risk premium, cost of capital. When we do the working, we do not incorporate all this, unlike net present value. That is why it is called internal rate of return. When I select the proposal is selected if IRR is greater than cost of capital, the required rate of return. Now, there are many advantages with internal rate of return. So, first of all, as with any discounted cash flow technique, it recognizes time value of money. Next, it is a relative measure. Now, it is very easy for decision makers to use internal rate of return. Why? Because NPV is an absolute measure, and internal rate of return is a relative measure. So, internal rate of return is an indicator of efficiency. So many managers, many decision makers, that there are three main problems with internal rate of return. What are they? The reinvestment assumption in internal rate of return is not realistic. IRR assumes that the company has other proposals with equally attractive inflows, wherein the interim cash flows generated by the current proposal can be reinvested. Now, this reinvestment rate for internal rate of return is totally unrealistic. Why? Because it overstates the annual equivalent rate of return for a project whose interim cash flows are reinvested at a rate lower than IRR but still above the cutoff rate. See, anyway, you will make the investment if it is above the cutoff rate. Supposing I'm able to identify a proposal, let's say the life is 4 years, where the IRR is, let us say, 35%. The interim cash, any investment, the other day also we saw, when we did bond, we saw, when we did equity, we saw, when we did capital budgeting, we saw, always, whenever I talk about investment, reinvestment of cash flows, that is a must. We discussed maturity in bond. So that time itself, we discussed this concept of reinvestment. So now the interim cash flows will be reinvested. At what rate will be reinvested? Under IRR, the assumption is totally unrealistic. It says it is being reinvested at the IRR. How? For high yielding proposals, the interim cash flows of that proposal, you will find other proposals which is also equally high yielding, not possible. All interim cash flows, as long as it selects it satisfies your criteria of being above the cutoff rate, you will do it. So that is unrealistic. This is the first problem. Then second problem, supposing a proposal involves unconventional, that is, what is a conventional cash flow? Conventional cash flow means any investment, what will happen? First, you will have an investment. Then what will happen? You will start getting cash inflows. Then you will have terminal. This is conventional. Now, unconventional cash flows means the direction of the cash flow changes more than once. That is, initially there is a cash outflow, then inflow. Then again some investment is necessary, then you get a inflow. Like that, if it keeps changing direction, there is a possibility of multiple IRR. If you have multiple IRR, it poses a problem for taking decisions. Why problem? Because one IRR is more than cost of capital. Another IRR is less than cost of capital. What will you decide? Will you take it or will you won't take it? This is one. Then the third problem is that IRR cannot be used to evaluate mutually exclusive proposals. It can be used only for standalone proposals. So these problems are there. And that is why IRR has to be modified. And we have what is known as modified internal rate of return. Now, modified internal rate of return, what we do, you already know. We will do it along with this problem. So, to this, can I say that you are clear with whatever we discussed? So now let us take the problem, continue reading the problem. XYZ Limited, a company based in India, manufactures very high quality modern furniture and sells to a small number of retail outlets in India and Nepal. It is facing tough competition. Recent studies on the marketability of the products have clearly indicated that the customer is now more interested in variety and choice rather than exclusivity and exceptional quality. Since the cost of quality wood in India is very high, company is reviewing the proposal for import of goods in bulk from a Nepali supplier. The estimate of Indian currency and Nepali currency. We have already seen when you have currencies like this, both domestic and foreign, then we should follow domestic currency approach. So you are given years 1, 2, 3, and 0, of course, is immediately what is the investment. So that is given in Nepalese currency as well as Indian rupees. We are given further information. XYZ Limited evaluates all investments by using a discount rate of 9% per annum. All Nepalese customers are invoiced in Nepalese currency. They are converted into Indian rupees at the forward rate and discounted at the Indian rate. Inflation rates in Nepal and India are expected to be 9% and 8%. Current exchange rate is 1 rupee is equal to 1.6 Nepalese currency. Immediately, you should recognize that what you have is indirect good. So, as always, I'll give you a few minutes for you to consider and do it, then we can discuss. So once you try, we can discuss. So find net present value. So have you tried? Can we check up? Shall we check up? Now, what do we know? We have been given cash flows. What should we do? We have to convert the foreign currency cash flows into domestic currency. For that, what is given? Expected inflation rate in Nepal and India given. The moment they talk about inflation rate, we know we are looking at purchasing power parity theory. Problem says forward rate, but purchasing power parity theory we can use and find expected spot rate. So we are assuming we need to take the expected spot rate. And then we also find that it is an indirect quote. Indirect quote means spot into 1 plus foreign inflation divided by 1 plus domestic inflation. So we will find the forward rate. And then we will use that. We will convert the Nepalese cash flows into Indian currency. Then you also have in Indian currency. So totally, what is it? What is discount given? 9%. And present value of this was 10%. That is how we need to proceed. So here 0, 1, 2, 3. Now we know that there are two approaches to do this. I'm following domestic currency approach, therefore domestic currency approach. Statement showing net present value, Nepalese currencies as well as Indian rupees. The problems, if the figures are given, say in millions, in crores, and lakhs, you also can take it that. So now we have the cash flows. Expected inflation rate is given. Spot rate is 1 is equal to 1.6 NC. Since it's an indirect quote, we know I have to do 1 plus FI divided by 1 plus DI. I find, apply that, get the cash flows. Risk adjusted discount rate is given as 9%. Use that for discounting, get the answer. So we have the present value of cash flows. From that, we can find net present value. Is this over? Are you clear? We have cash flows in Nepalese currency. We have expected inflation rate in Nepal and in India. So we find the expected spot rate using purchasing power parity theory. How do I know I have to use purchasing power parity theory? I know that because inflation rates are given. It's an indirect quote. So accordingly, I find the expected spot rate. Then problem says forward. So I have mentioned forward rate, but then using purchasing power parity theory, what we find is only expected spot rate and not forward rate. This is why I mentioned that also expected spot rate. And then what is the cash flow? Indian currency. What is the total? Use the discount rate, get the net present value. Okay, that is done. Then, what is the question? Assuming that you are the finance manager, calculate the net present value. We have calculated and modified internal rate of return. We modify the internal rate of return and use modified internal rate of return technique to overcome the disadvantages or limitations in IRR. What are the limitations? We saw three limitations. One is the reinvestment rate assumption is unrealistic. And two, that when the proposal involves unconventional cash flows, then we will have a situation where we will have multiple IRRs and then we cannot use it for mutually exclusive proposals. This is what we saw. So how do we go about finding modified IRR? What we will do to find modified IRR? What is the first problem for me? The reinvestment in rate assumption is unrealistic. So what I will do? I will simply take the cash flows compounded at the cutoff rate. Then if I have outflow more than once, I will bring everything to year zero again using the cutoff rate and then find the rate at which we have the cash inflows and outflows to be equal. That is how we will find modified internal rate of return. Now, first year, if you look at it, what is it I have? I have the cash flow to be 4.4791. I have to take it to third year, so I have to compound it for 2 years. Second year cash flow, I have to compound it once. Third year, it's already in the third year, I don't have to do anything. What is the future value of cash inflow in the third year? What is the present value of cash outflow in year zero? Now, what is it I know? At IRR, present value of cash outflow is equal to present value of cash inflow. Present value of cash inflow is equal to future value cash inflow into discount factor. Present value of cash outflow is equal to, since these two are same, future value of cash inflow into discount factor. So discount factor will be present value of cash outflow divided by future value of cash inflow, which is what I have. That gives me 0.7 system. So I will find out what is the rate at which I'm having this. I find that the 7th year discount factor for third year is 0.8163. For 8%, it is 0.7938. 0.7999 is in between these two. So I will interpolate and find the MIRR to be 7.73. So if you are through with this, we can move on to the next problem. Now we can see one more problem in this, where we will take the real cash flow, nominal cash flow, that matter. Can I take it that you have completed this? So let's do one more problem in this. Find NPV of the project using domestic currency approach at risk-adjusted discount rate of 20%. So clearly mentioned, follow domestic currency approach and domestic risk-adjusted discount rate is given. XY Limited is engaged in large retail business in India. It is contemplating expanding into a country in Africa by acquiring a group of stores having the same line of operation. The exchange rate for the currency of the proposed African country is extremely volatile. Rate of inflation is presently 40% a year. Inflation in India is currently 10% a year. Management of XY Limited expects these rates to continue. Estimated projected cash flows in thousands in real terms. This is what is important. In real terms, unless otherwise specified, we said it will be nominal. But here, clearly given, it is in real terms. So that we have to consider. In India as well as African country for the first 3 years, they have given. XY Limited assumes the year 3 nominal cash flow will continue to be earned each year indefinitely. The present exchange rate is African Rand 6 is equal to rupee 1. Find NPV using domestic currency approach, registered discount rate. As always, I'll give you a couple of minutes, then we can let the problem sink in, then we can discuss the answer. So now let's take it up. So what do we have now? Real rupee cash flows in India given. Inflation rate we know. So we can find the inflation factor. Nominal rupee cash inflows in India, how much it will be? At zero date of the project, present value is present value. So no problem, we will take one. Minus 1,500, which we have, that is at the end of first year, but it is given in today's terms. So once I should compound 1 into 1.1. Similarly, second year 1.1 into 1.1. Third year 1.1 into 1.1 into 1.1. Nominal rupee cash flows, what it is. Real African Rand cash flows, what is it in Africa? These are in real terms. Inflation factor for Africa we know because 40% inflation rate is given. Find the inflation factor, apply it, get the nominal Rand cash flows. Up to this, is it okay? Then spot exchange rate given. Expected spot rate using purchasing power parity because we have the inflation rates. So we find the expected spot rate. So once this is done, we have the expected spot rate. We find that it is in direct code, so accordingly we arrive at the rate. Now African cash flows, what you have? Convert it into Indian rupees using the expected spot rate. Now you already have cash flows in India together. See how much should be nominal cash flows, both in India as well as Africa. Then risk-adjusted discount rate you employ, get the present value. So we have found the present value of cash flow. Now year 4 to perpetuity. So A divided by R. Now I take A4, that is 4th year onwards. What I get is value at year 3. Take the discount factor. Get the present value of what you will get from the 4th year onwards. Get the net present value. Are you interested? Not interested. If we are through with this, we can move on to the next one. Is this done? Shall we move on? Shall we look at the next problem? So since we get the answer to be negative, not at all interested in accepting the project. So is this over? Shall we move on? Can I stop sharing this? Shall we move on? Let's move on to the next one. Assume that there is no variation in the exchange rate of the two countries. All profits will be repatriated and there will be no withholding tax. These are the assumptions. TG Limited, a multinational company, is planning to set up a subsidiary company in India where hitherto it was exporting. So till now, it was only exporting from its country to India. But now they want to set up a subsidiary in India itself. This is in lieu of growing demand for its product and competition from other MNCs. The project cost consisting of plant and machinery, including installation, is estimated to be 500 million USD. Net working capital requirement are estimated 100 million USD. Company follows straight line method of depreciation. Presently, the company is exporting 2 million units every year at a unit price of 100 USD. Its variable cost per unit being 50 USD. The Chief Financial Officer has estimated the following operating cost and other data. Variable operating cost 25 USD per unit of production. Additional cash fixed cost 40 million. Production and sales capacity of the proposed project in India 5 million units. Expected useful life, production and sales capacity. Note that. Expected useful life of the proposed plant 5 years salvage value. Existing working capital investment for production and sale of 2 million units was 20 million. Export of the product in the coming year will decrease to 1.5 million units in case the company does not open a subsidiary. In view of the presence of competing MNCs that are in the process of setting up their subsidiaries in India. Applicable tax rate 30%. Required rate of return for such a project is 12%. Please try to discuss. If you are ready, we can discuss. There are two options now. You can export or you can set up a subsidiary. So first we can evaluate the export option. Then we can look at the subsidiary option. We can decide which is better. Okay, that's enough time. Shall we check up? Now, what do we see? If the company continues to export, then we will see what is the position. We will take dollars in million. Working capital now will be 15 only, because if you decide and continue to export, then what happens? What have they said? Export of the product in the coming year will decrease to 1.5 million units. So if you decide that you don't want to open a subsidiary, but only continue to export, now the sales will come down, and when that comes down, working capital will also come down. So what is the investment in working capital? What is the selling price? What is the variable operating cost? What is the contribution? What is the sale quantity? Total contribution. What is the taxable profit? How much is the corporate tax rate? Operating cash inflow. Annuity factor. Then what is the present value of operating cash inflow? Then we will consider the recovery of working capital also. This is it okay? So is this over? What is the present value of operating cash inflow? Now, recovery of working capital, you will have apply the discount factor. Present value of working capital. What is the net present value from export? We have the initial cash outflow, operating cash inflow, and capital inflow. What is the final effect? Net present value if you export. What is the position? So once this is done, let's see what is the position if we establish a subsidiary. If we establish a subsidiary, what happens? Let's see. What happens? Now, investment in plant and machinery, investment in working capital. So how much is the initial capital flow? That is an outflow. Now, what is the selling price? What is the variable operating cost? Therefore, what is the contribution? Multiply with the sale quantity to get the total contribution. Deduct the cash fixed cost. Then depreciation. Find out what the taxable profit is. So this is it. Okay. Now, taxable profit you found. Deduct the tax, get profit after tax. Add back depreciation, get operating cash inflow. Apply the annuity factor. Find the present value of operating cash inflow. Recovery of working capital is there in year 5. Discount it. Get the present value. Get the net present value. Net present value will be initial cash outflow, annual operating inflow, and terminal inflow. So compare that with the net present value which you have if you continue to export. There is incremental net present value for setting up a subsidiary. So what should be the decision? Is this clear? Shall we move on? Is this done? So now let's move on to the next one. Now let's try this. If the interest rates given above are market determined, examine which loan is the most attractive using interest rate differential. A German subsidiary of a US-based MNC must mobilize 100,000 euros working capital for the next 12 months. So following options are there. It can get a loan from German bank for which interest is given. US bank, yes, interest is given. Swiss bank, interest is given. Banks in Germany charge an additional 0.25% per annum towards loan servicing. Loans from outside Germany attract withholding tax of 8% on interest payment. So you can try. Of course, withholding tax, no, it's like a retention tax, TDS. Now, this is a beautiful problem. So how do we go about it? Can we simply compare 5%, 4%, 3% and say that loan from Swiss bank is the cheapest? We can't do that because other things are there. And the exchange rate will also move. If interest rates given above are market determined, examine which loan is most attractive using interest rate differential. Now, using interest rate differential, why is this given? We already discussed interest rate parity theory yesterday, by under which interest rate differential and exchange rate differential will be the same. We need to use that concept and then do this problem. So, what is the working capital loan amount? We know. Now, lending bank would require interest rate net of withholding tax because they are all market determined. The lending bank is not going to allow you to deduct and give a lower amount. If you don't want, then the others will take it. So that they are not interested. So what should we do? When you say interest rates are market determined, it indicates that the rates will be the same for everyone. There is no room for negotiation. Differential pricing, interest rates, it's not possible. So net of the withholding tax, they should get that. That is the meaning. The market determined rates are the rates which the foreign bank should get net of the withholding tax. So withholding tax has to be borne by the German company. So now let's see how to go about it. What is the working capital loan? That is the euro inflow. Required interest rate. This is net of withholding tax of 8% by the lending bank. So net interest amount to be received by the lending bank. This much they should get. Then additional loan servicing charge. What is the amount? This is applicable only for the German loan. Now withholding tax, how much? So gross interest cash outflow from the German subsidiary. Before considering depreciation of euro, Why will there be depreciation of euro? Because interest rate is high. Yesterday, interest rate parity theory we discussed. We know whichever country has a lower interest rate, that will be at a premium. Whichever country has a higher interest rate, that exchange rate will be at a discount. You know. So before considering depreciation, how much it is? After considering depreciation, how much it is? After considering depreciation means differential interest rates we need to apply. In Germany, 5%. In US, 4% means into 1.05 divided by 1.05. So effectively, how much is the interest amount means? You should deduct the 100,000 euros and get the effective interest amount. So if this is the amount, effective interest amount, and the loan also we know. So find as a percentage. You find that loan should be taken from Germany because that is the effective rate. If you look at that is the cheapest. Is this clear? Have you completed? Shall we move on? Have you completed this? Shall we move on? Next, let us take another problem. You can try this. Advise the company whether the offer from the foreign branch should be accepted. So Sun Limited is planning to import equipment from Japan. The cost is given as 3,400 lakh yen. It can avail a loan at 18% with quarterly risk. They also have an offer from Osaka branch who can extend a credit of 180 days. So additional information is given. What is the present exchange rate? What is the 180 days forward rate? Commission charges for letter of credit. That is also given. So please try. So first, let's find out if we take a loan, what will be the repayment in 180 days? So the invoice amount to be paid to the supplier, how much? It's given in lakh yen. Then what is the spot rate? So how much you require? It is given that the interest is in quarterly res. Therefore, how much it is? What is the loan repayment? So what will be the amount of loan you will take? How much is the interest you will pay? What will be the loan repayment? You have another option. The company has also an offer from Osaka branch of an India-based bank extending credit of 180 days at 2% per annum against opening of an irrevocable letter of credit. So that case, let's see what we do. What is the invoice amount to be paid? What will be the interest on loan? How much should be paid in 180 days? This is again 180 days forward rate is there. So what is the INR to be paid? But you will have to pay an upfront commission. So that you will have to take it at spot rate. So for that commission, how much will be the loan to be taken? For that, how much is the interest? Then we will see what is the total. The upfront commission, we need to take a loan and that along with interest. Again, this interest also will be quarterly res. So what is the total amount to be paid? There you had 1092, whereas here it's only 1006. So that's the saving. Let's move on to the next problem. Calculate the overall cost, both in percentage and rupee terms, on an annual basis. What is the cost of hedging in rupee terms? If K Limited wants to pursue an aggressive approach, what would be the net gain or loss for K Limited if the INR depreciates or appreciates against GBP by 10% at the end of 5 years, assuming that the loan is repaid in GBP at the end of 5 years? Now let us see. K Limited currently operates from 4 different buildings and wants to consolidate its operations into one building, which is expected to cost 90 crores. The board of K Limited had approved the above plan and to fund the above cost agreed to avail an external commercial borrowing of GBP 10 million from G Bank Limited on the following conditions. So 90 crores, and we have decided to avail a loan for 10 million GBP. The loan will be availed on 1st April with interest payable at half-yearly rates. Average loan maturity life will be 3.4 years with an overall tenure of 5 years. Upfront free 1.2%. Interest cost is GBP 6 months LIBOR plus 2.5%. Of course, LIBOR has been withdrawn, but in the question, whatever they give as the benchmark, we will accept. 6 months LIBOR is expected to be 1.05%. K Limited also entered a GBP INR hedge at 1 GBP is equal to INR 90 to cover the exposure on account of the above GBP loan. And the cost of the hedge is coming to 4% per annum. 1 GBP is equal to INR 90. Please try. Now, there is a term in this problem. What is that? Average loan maturity life will be 3.4 years. What is the meaning of average loan maturity life? What does it mean? Now, average maturity life, average maturity period, average loan maturity, weighted average maturity, all this means the same. What is it? Now, it is calculated See, some bonds repay the principal in a lump sum maturity. Others repay the principal in installments over the term of the bond. In cases where the bond's principal payments are spread over its life, the average life helps investors to determine how quickly the principal will be repaid. So, what is the advantage of average loan maturity life? How do you find average loan maturity life? Sum of the weighted repayments divided by sum of total repayments. This will give me the average loan maturity. What are the advantages? Why should I have this average loan maturity? First advantage is that it is used for credit risk analysis. The main credit risk associated with the loan is the risk of loss of principal. A bond with a longer weighted average life has a greater credit risk than a bond with a shorter weighted average life. What is the first use? The main credit risk associated with the loan is the risk of loss of principal. A bond with a longer weighted average life has a greater credit risk than a bond with a shorter weighted average life. Then, interest computation. Total interest payments over the life of the bond can easily be computed using weighted average life. Now, you may wonder whether duration and weighted average life are the same. No, duration and weighted average life are the same. They are different. What is duration? Duration is the weighted average maturity of a bond where the weights are the relative discounted cash flows in each period. Duration is the weighted average time to receive the discounted present value of all cash flows. Weighted average life, on the other hand, considers principal repayments only. Duration considers both principal and interest repayment, whereas weighted average life considers only principal repayment. Weighted average life does not consider time value of money. Duration considers time value of money. Weighted average life, for what it is used, is technique to assess credit risk. Duration is a technique to avoid interest rate risk. So they are different. Weighted average life and duration not same. So how to find weighted average life? How to find weighted average life? Let us say weighted average life. This does not have any connection to the problem we are doing now. Just to understand the concept of weighted average life, I am telling you how it is to be done. Then we can come to this problem. What is weighted average life? See, I'm taking a different situation. This has got no connection with this problem. I'm explaining to understand what is weighted average life. Let me say I have a face value of bond to be 200 and interest rate to be 10%. There are 4 years, 1, 2, 3, 4. The sum of repayment. What is the principal amount repaid? First, I'm looking at a situation where the entire amount is repaid only at the end. In that case, how will I find weighted average life or average loan maturity life? I take the weighted repayment. So 200 at the end of 4 years only. So 800. Average loan maturity life is whatever is the weighted repayment minus the sum, which is 200. So 4. Now with this weighted average life, I can very easily find how much is the interest amount because loan amount into weighted average life into interest rate. I get the interest. And if we are done independently every year also, we know it is 80. Let us take another case. There has been some principal repayment 20, 40, 60, 80. Then weighted repayment, let me find 20 into 1, 40 into 2, 60 into 3, 80 into 4. So totally 600 I'm getting. In this case, what is the weighted average life? 3. That is 600 divided by 200. Now, interest based on the amount outstanding, if we compute, then also I'm getting 60 or loan amount into weighted average life into interest rate. Similarly, if I have equal repayment every year, what happens? If I have decreasing principal repayment, what happens? So what do we know? Average loan maturity life is equal to sum of weighted repayment divided by sum of total repayment. Total interest amount over life is equal to principal amount into average loan maturity life into interest rate. Is this clear? So here in this problem, we have weighted average life. What will it be? How will it be useful to us? By finding interest, we require that because you do not have the repayment schedule, the loan structure, the interest structure is not given. So you have understood weighted average life, isn't it? Weighted average life means weighted average life, average loan maturity life, everything means the same. Sum of weighted repayment divided by sum of total repayment. Total interest amount over the life will be principal amount into average loan maturity into interest rate. So now we can move on to this problem. So here, what do we know? If we take this problem, it is given average loan maturity life is 3.4 years. So this will help us to find out how much is the interest amount. This will help us to find how much is the interest amount. So now let us take this problem. External commercial borrowing on 1,490. How much have you taken? What does the problem say? How much are they taking? They are taking 10 million. So we take 10 million. Then average loan maturity life is given as 3.4 years, but overall tenure is 5. We do not have the structure of the loan, so we don't know how much, what has been paid and all that. But since we have the average loan maturity life, we have no problem in computing the interest. Upfront fee is 110. Then applicable interest rate, because 6 months LIBOR is given, and I know the credit spread, I can find out how much it is. Cost of hedge is given to be 4% per annum. And let me consider that also. And GBP INR rate, as far as the hedge is concerned, how much that is also given. Now this is per annum 3.5%. This is also per annum 4%. So multiply with the average loan maturity life for you to get the rate for this easily. So what do we know? Upfront fee we can take. And if you look at it, totally how much? If you want to compute as a percentage, 12.07% plus 13.6% plus 1.2%, or we can look at it by means of amount and then get the same 26.87%. There are two ways in which we could have got the amount and then the percentage, or we could have got the percentage and then the amount. Overall cost. If you look at the problem, the requirement of the problem is to calculate the overall cost both in percentage and rupee terms on an annual basis. So one of the two ways you can find. So what do we have? What is the external commercial borrowing? What is the average loan maturity? What is the overall tenure? Upfront fee, how much? 6 months LIBOR, how much? What is the credit spread? What is the applicable interest rate? What is the cost of hedge? What is the GBP INR rate? These are the basic information given in the problem. Now, upfront fee is one time. So find out how much it is. Overall interest cost, how much you find, because we know 3.55%. We already discussed the principal amount into whatever is the weighted average life multiplied by the interest rate will give you the interest cost. Because the term structure, because the loan structure is not given to us, how much they are repaying then. But weighted average life is given. We use that to find the interest cost. I already showed you how, whether we take the repayment schedule and then find weighted average and find the interest cost, or we take the weighted average life and find the interest cost. It's the same. So overall cost, how much? 2687. How much have you received? Though it is 10 million, upfront fee 1,20,000 is gone. Therefore, you got only 9880. This is like net proceeds. Whenever we find cost of capital, we used to divide by net proceeds. Same thing. Per annum, what is it? In percentage terms, as well as in amount. That is the requirement, first requirement. overall cost how much. Is it clear? Shall we go to the next step? Then what is the next requirement? Calculate the overall cost both in percentage and rupee terms on an annual basis. We have done. We have found overall cost in percentage terms, that is 8%, and also in rupee terms. Both are over. Now, what is the next requirement? What is the cost of hedging in rupee terms? Cost of hedging, we already know. We found 1360. That in rupee terms, how much? Per annum, how much? In rupee terms total and in rupee terms per annum. Since weighted average life is 3.4 years, for everything we have to find 3.4 years. Next. If K Limited wants to pursue an aggressive approach, what would be the net gain or loss for K Limited? If the INR depreciates or appreciates against GBP by 10% at the end of 5 years, assuming that the loan is repaid in GBP at the end of 5 years. Now, before we discuss the answer for this, we have to discuss what is an aggressive approach. Aggressive approach means what? What is meant by aggressive approach? Aggressive approach means you don't go for hedging. That is what is known as aggressive approach. If you don't go for hedging, and if you look at the problem says that assuming that the loan is repaid in GBP at the end of 5 years. So here, actually average loan maturity in this case is 3.4. But in a hypothetical situation, supposing you follow an aggressive approach, that is, you don't hedge at all, and you repay only at the end of 5 years, then what happens? We have to see it. For the two scenarios are given. If INR depreciates, appreciates against GBP by 10%. Why not this? I'll have to tell you. This appreciation, depreciation matter. Let us say we are looking at a currency pair. Which currency pair? It can be anything. Now, I'm not talking about this problem. Generally, to understand a concept, I'm telling you something. Let us say we are looking at a currency. Let us say we are more interested in USD INR currency pair. So let us say that is what I am actually looking at, USD INR currency pair. What is it I know? If one currency in the currency pair appreciates, then I know necessarily the other currency will depreciate. Do I know this? If one appreciates, the other necessarily has to depreciate. But the rate of appreciation in one and the rate of depreciation in other will not be the same. Have you understood what I'm saying? Clear what I'm saying? I'm talking about a currency pair. What is the currency pair I'm talking about? USD INR. In the currency pair USD INR, let us say USD appreciates. Then what does it mean? INR will depreciate. If USD appreciates, let us say by 20%, will INR depreciate by 20%? No. Then one currency appreciates, the other currency in the currency pair will necessarily depreciate. The rate of appreciation of the first currency and the rate of appreciation of the next currency will not be the same. This is understood. This is understood. Now, let us take an example and see how it is working. Let us take an example. For us to understand this concept, let us take an example. I will take again the example of USD INR. What is my home currency? INR. What is my foreign currency? US dollar. Let me take US dollar as base, INR as terms, the direct quote. So let's see, let me take a case where whenever I want to understand a concept, I have to use examples where I have extremes, okay? So that I understand the concept well. Let us say, I'll stop sharing this and share something else. To explain this point. Okay. Now, what is the situation? I am looking at USD INR pair. What is the domestic currency, home currency? INR. What is the foreign currency? USD. I am taking a direct quote. Direct quote, foreign currency will be the base, so USD is the base. INR will be the terms. So first I am looking at $1 is equal to 50. Then let us say for a period of say 5 months, 6 months, whatever. $1 or a period of 1 year. From $1.50 it became $1.80. So what is the dollar appreciation? Change, which is 80 minus 50, 30, divided by 50, 60%. Is it clear? Is this point clear? Okay. Now, let us take the other scenario. We know clearly now dollar has appreciated 60%. But has INR depreciated 60% means no. We know that to convert one quote into the other, we need to take the inverse. Now, I should have whichever currency is appreciating or depreciating, that I should have as the base. Therefore, INR base when I see $1 is equal to 50 INR is the same as 1 INR is equal to 0.02 USD. Similarly, 1 INR is equal to 0.0125 USD. Now you look at the depreciation, it's only 37.5%. So what do I know? A 60% appreciation in dollar is only a 37.5 depreciation in rupees. So the appreciation or depreciation in one currency, in a currency pair, will not be equal to the depreciation or appreciation in the other currency. Is this point clear? Why am I telling you all this? Because now when you look at the problem, what does the problem say? What does the problem say? When you look at the problem, what is the problem saying? Which currency is appreciating or depreciating? That we need to look at. Based on that only, we should apply. That is, whichever currency is appreciating or depreciating, that currency only we should look at. We should apply the appreciation or depreciation in that currency only. So when you look at the question, what does the question say? If INR depreciates or appreciates against GDP by 10%, so this appreciation depreciation should be employed, should be applied only with INR being the base. Then only the correct appreciation depreciation will come. To look at that only, I asked you to discuss that. So now, what is the spot rate? 1 GBP is equal to 90. Had I made it indirect, what it would be? 0.0111. INR depreciates by 10% means what it will be. Therefore, 1 GBP is equal to what it will be. For this, let us see whether there is profit or loss. Now, settlement, you make this much. There is a loss from not hedging because the amount has increased. On the other hand, when INR appreciates 10%, what is the position? It is wrong to take it as 99 and 81. Have you understood why I explained this concept? That in a currency where if one currency appreciates, necessarily the other currency depreciates. But the appreciation in one currency is not equal to the depreciation in the other currency. Is this clear to you? Have you clearly understood why it is a mistake to take 90 plus 10% 99 and 90 minus 10% 81? Because 1 GBP is equal to 90, has GBP as the base. If I apply 10% up and 10% down, it means the appreciation in GBP is 10% and depreciation in GDP is 10%. But the question is talking about appreciation and depreciation in INR, not in GBP. So what is the gain? What is the loss? So if this is done, there are a few more points I want to tell you regarding this problem. The loss which we have here would be reduced by the hedging cost saved. Because if you are taking an aggressive approach, then you are going to have save on the hedging cost. So that will be saved. In case of gain, the gain would be increased by the hedging cost saved. Now, weighted average life in the problem is less than 5 years. Therefore, the loan has been paid in less than 5 years because 3.4 years only given. But in the sub question which we have discussed now, they have said at the end of 5 years only. So I cannot compare this, and that is why I have not said how much is the hedging cost saved. Whether it is a hedging or the aggressive approach which they have asked, only principal amount is considered and not for the interest amount because we do not have the interest. So, is this understood? Is it clear? Can I take it that this is understood? So, let's have a break and then continue. Okay, shall we have a break? Let's have a break. Shall we continue? Next, let us move on to international treasury management. That is what we are going to discuss next. Now, what is treasury management? How, for an MNC, the treasury management is different. That we need to discuss. What is treasury management? Yes. Intermediate level, working capital, we have treasury management. Treasury management functions, it includes what? Three things: cash and currency management, working capital management, financial risk management. What is it? Cash and currency management, working capital management, financial risk management. Cash and currency management, liquidity. We know that cash management, see, normally only domestic transactions are involved means it will be cash management. But for an MNC, we do have foreign currency also involved. Therefore, what we are having is cash and currency management. Whether it is cash management or currency management, it is balancing or looking at a trade-off between liquidity and profitability. Then working capital management. In working capital management, what is our interest? Our interest is that I need enough cash for business that I have to mobilize. The cost of borrowings I have to minimize. If I have any surplus cash, I have to maximize the return for the surplus cash. This is our working capital management. Then financial risk management. Financial risk management, I'm looking at financial risk management in three markets. What are they? Commodity market. In commodity market, what is my interest? I'm interested in reducing price risk. Then I'm looking at effective dealing in money market. In money market, what is it? I'm interested in reducing interest rate risk. Then effective dealing in forex market. Why? Because I want to reduce exchange rate risk. So three things are there. Commodity market, to reduce, I have to effectively deal in commodity market to reduce price risk. I have to effectively deal in money market to reduce interest rate risk. I have to effectively deal in forex market to reduce exchange rate risk. So when I talk about treasury management, I'm looking at cash management, currency management, fund management, banking, corporate finance, everything. That is clear. So now we discussed about exposure netting and all. Now all that comes here. Now, normally what happens? MNCs divide their operations into three major areas. And they establish treasury centers in each of these areas where there is a well-developed capital and currency market. What are the three major areas they will divide geographically? One would be the Americas, for which, of course, the hub will be in New York. Then they could have in Europe, for which they could have it in London or Switzerland or Frankfurt or Amsterdam, one of these places. Then Asia Pacific, of course, they will have Singapore or maybe Hong Kong or Tokyo. Now, as centralized treasury management, or having a centralized cash management in the treasury management in an MNC, it will help the MNC in cash and liquidity to generate maximum return by investing all surplus, because many places they have a overall view, and it also helps in risk management, because we were discussing the internal hedging techniques, the exposure netting and other things. Those things can be effectively applied if you have a centralized cash and treasury. So that being the case, shall we look at problems in treasury management? Now, before we do problems in treasury management, there is a cross-currency rate, which you need to know. What do you mean by a cross-currency rate? See, supposing you have an exchange rate between two currencies and exchange rate between one of these currency and another currency. You try to find the exchange rate between two currencies using a third currency. That becomes a cross-currency rate. So what is a cross-currency rate? The cross-currency rate would refer to one of the two things. See, normally any exchange rate is quoted for a currency pair. So when I look at cross-currency, it refers to an exchange rate where the exchange rate for two currencies is computed using a third currency. A cross-currency rate refers to the exchange rate between two currencies computed by using a third currency. What will this third currency be? The third currency can be the domestic or official currency of the country in which the quote is given, or USD. So cross-currency rate means I want the currency rate, exchange rate between two currencies. I will find the exchange rate between two currencies using a third currency. That is cross-currency rate. The third currency will either be my official currency in the country in which I'm operating, that reporting currency, that official currency, or it could be US dollar. So the idea and the concept of cross-currency should be known before we get into this problem. So let's take this problem. So what is this problem? Your bank, of course, the requirement is at which center will the investment be made and what will be the net gain to the nearest pound to the bank on the invested funds. Your bank's London office has surplus funds to the extent of 500,000 US dollars for a period of 3 months. The cost of funds to the bank is 4% per annum. It proposes to invest in London, New York, or Frankfurt. See, what is it? They will divide into 3 areas. He said you will have either London or Frankfurt in Europe. You will have New York in America. So that is where they will have the centers and obtain the best yield without any exchange rate risk to the bank. Now, without any exchange rate risk to the bank is to indicate that a forward should be used. We know that a forward contract is entered to peg the rates. So the following rates of interest are available at the 3 centers for investments of domestic funds there for a period of 3 months. So if you invest in London, you need to invest in GBP. If you invest in New York, you have to invest in USD. If you invest in Frankfurt, you have to invest in euro. That is what they are saying. The market rates in London for US dollar and euro are as under. So London, it is stated. The market rates in London for US dollar and euro. So rates are given. You observe that swap points are given. We had a detailed discussion on swap points yesterday. And we know if it is low, high, we have to add. If it is high, low, we have to deduct. If it is low, high, it means the base premium, the base currency is at a premium. If it is high, low, it means the base currency is at a discount. So we have the rates now. So you can try. Please try. The surplus amount available is 500,000 US dollars. The cost of funds to the bank is 4% per annum. Surplus is available for a period of 3 months. So 4% per annum means only 1%. Is this clear? So why don't you try? Maybe we will, the possibility of investing in 3 places is given. We could take one by one and then solve and discuss. $4% for 1 year, for 3 months, 1%. So what does it mean? That 500,000 plus 1% of that 5,000, 505,000 is what you have to return. Over and above what is there is the gain. First we have London on New York, which means what is given is GBP USD. So GBP will be the London on New York. So GBP will be the base and USD will be the terms. We already know that matter. That hierarchy we discussed, isn't it? Didn't we discuss the hierarchy? GBP is there, USD is there, it will always be 1 GBP is equal to now this is in the London market. London market, they are quoting as 1 GBP is equal to how much? So this is 1 GBP is equal to how many USD? This is 1 GBP is equal to how many euros? So now, how do we go about solving this? Surplus funds, 500,000 US dollar is there. What is the period? 3 months. What is the cost of fund? 4%. For 3 months, how much? 1%, because that is an annual rate. So 5,000, you have to repay the amount as 505,000. So after investment, whatever investment receipts you get, from that deduct 505,000, balance only will be. Next, we have the GBP USD quote. 1 GBP is equal to so many USD. Therefore, GBP is the base, USD is the terms. USD per GBP spot bid rate is there. We are looking at a period of 3 months. So 1 month, 2 months and all what is given is irrelevant for us. And 3 months forward stack points is low high. Therefore, we will add. If it is low high, the base currency is at a premium. Therefore, we have to add. So once we have this rate, let us see what we do in London. Now GBP investment in London, if you make the investment, it has to be in GBP for the local it is given. So in London, you make the investment, it has to be in GBP. Surplus funds is 500,000, period of 3 months. The interest rate per annum of deposits is 5%. Now, what should you do? What do you have in your hand? You have USD. You want to buy GBP by paying USD. You want to buy GBP. So what is applicable is the ask rate. You want an inflow of GBP and an outflow of USD. USD per GBP spot ask rate is there. So how much is the investment you can make in London? What is the interest rate? What is the interest income? What is the investment receipt after 3 months? Now you have to repay 505,000. So whatever is the amount that is required, you will have to find out. You have to sell enough GBP in order to get the 505,000 US dollar. You are selling GBP. Therefore, bid rate is applicable. What is the net gain? They have said round it off to the nearest pound. Therefore, we have rounded off. What is the 3 months forward bid rate? Is this term? The New York is the easiest to do. There are 2 ways of doing it. You have surplus funds, 500,000 US dollar, period is 3 months, cost of funds 4%. Interest rate per annum on deposits 8%. How much is the investment? It's already US dollar. You have to invest US dollar. So investment made in New York is 500,000. What is the interest rate for 3 months? Because per annum it is 8%. What is the interest amount? How much you will receive? You have to repay 505,000. Therefore, the net gain will be 5%. Now you have to give it in GBP. Therefore, you can consider the forward aspect. You want to buy GBP using USD. So this 5,000, if you buy GBP, it is 3231.02. Again, they have asked you to round it off to the pound, so we can do it. This is one way of doing it. There is another way, much easier way, we could have found this answer. Then another way in which we could have done. I have USD, I'm going to invest in USD only. The difference in interest rate I could take and surplus funds on that 1% is the differential I will get. Convert it into GBP. Same story. This is another way in which we could have found. There's a much easier way of it. We need not even look at all the details, total investment proceeds, so much and all that, because the amount is the same, the currency is the same. We can simply take the difference in interest rate and give that as a case. Next. This London on Frankfurt. This is what we have to look at. What you have is USD. What you want is Euro. You have GBP USD. You have GBP Euro. So how will you go about? Now this only will be a little confusing. So now again, let us look at the rate. London on Frankfurt. GBP base Euro terms. So we have 1 pound is equal to. Then forward swap points we already observed. It's high low. So what is the rate? You have to deduct it. In the forward is high low, It means that the base currency is at a discount. So now once we have the rate, what should we do? Euro investment should be made in Frankfurt. I have surplus funds of 500,000 USD. Period is 3 months. Cost of funds is there. Interest rate per annum on deposits in Frankfurt is 3%. Now deposits I know should be in euro, which means I need a euro inflow and a USD outflow. So I do not have a direct rate between euro and USD. So euro should be bought using USD. What I want is USD per euro ask rate. So what should I do? USD per GBP ask rate into GBP per euro ask rate. So spot ask rate, you have USD per GBP. You want USD per GBP. Then you have the next rate, you want USD per euro, but what you have is the other way. So euro per GBP, always from bid to ask, 1 divided by, you take the inverse. So what is the spot currency rate? What I have is euro per GBP. What I want is GBP per euro. So if I want the ask rate, I should take the bid rate there and take the inverse. Okay. Now this is done. Let me see how much is the investment that is made in Frankfurt. For that, how much interest I will get. So what will be the investment receipts? Then 3 months forward, what is the rate? Therefore, how much will be the investment receipt in GBP? USD to be repaid, I know. So at the forward rate, how much I have to sell? So what is the net gain? So what is my decision? So what will be the gain I get in each of these? What is my decision? So finally, what is my decision? London, I'm getting only 1663. Frankfurt, I'm getting only 2022. So New York, I'm getting 3231. I prefer to invest in New York. That is my conclusion. That is my decision. Is this clear? Is there any doubt in this? Now we could try another problem. So let us try this problem. Is there any advantage of swapping euros and Swiss franc into sterling for investment? Supposing you are the treasurer of XYZ PLC in UK. XYZ has two overseas subsidiaries, one based in Amsterdam and one in Switzerland. The Dutch subsidiary has surplus 725,000 euros, which it does not require for 3 months, but which requires the end of 91 days. Swiss subsidiary has a surplus of 958,077. It will need after 3 months. Again, in UK, they have 75,000 pounds. That is not needed for the foreseeable future. So 3 centers, you have 3 different amounts, which is there, and all of which is not required for 3 months. The exchange rate. Spot rate, 91 day, again points are given. You know how to adjust it. 3 months deposit interest rate is given. And then you will have to state whether there is an advantage in swapping euros and Swiss franc into sterling for investment. Is there any advantage? You have to tell. So why don't you try this? This problem is different, not the same as what we had earlier. This is different. Please try. Then we will discuss. As always, I'll give you some time. You can try, then we can discuss. This problem is very different from the other problem which we have done. What is the question? The question that is asked is there any advantage of swapping euros and Swiss franc into sterling for investment? So what is it they want you to do? It has 2 subsidiaries. You have the Dutch subsidiary and you also have in Switzerland. The treasury is located in London. Exchange rate quotes are given in London. The currencies are exchanged in London at the London market rate. That is what is given. Is there any advantage of swapping euros and Swiss franc to GBP for investment? Question contemplates two scenarios. Invest euros, CHF, GBP at the respective markets locally, or exchange euros and CHF into GBP and invest in London. Supposing they have worded the question, is there any advantage swapping euros or Swiss francs or both to GBP? Then we should have further explored. Invest euros in Amsterdam and CHF and GBP in London. Invest CHF in Switzerland and euros and GBP in London. Locally, you invest, what happens, you see. Everything you consolidate and invest, what happens, you see. Which is better? You decide. Okay, shall we? Have you considered? Are you clear? Two options are there. Each place you simply invest locally or you consolidate everything and invest. Two options are there. What do you have? So first, investing locally, what is the position? So what do we say? When surplus funds are invested locally, you have the surplus amount in euro, in CHF, and in GBP. The local annual interest rates we have. but we are looking at a period of 3 months. Now this 90 days, 3 months and all, we can just take it as 3 months. What is the interest amount? This is what you have got locally. Is this clear? Now, in every center, whatever we have earned, that has to be converted to GBP. The principal, if you invest locally, the principal will be retained at the respective centers and the interest alone will be converted and retained in London. So the euro interest earned, the exchange rate, you find that the swap points are low high. When the swap points are low high, we know that the base currency is at a premium. Therefore, add what is the interest amount. Similarly, you need to do for the other two. Please try. Let's move on to the next one and see how much is the interest and when converted into GBP, what happens. With regard to investment in UK, it is already in GBP. So what do we know now? The total interest amount when you invest locally, what is the amount we get? If we consolidate and invest, let's see what we are getting. Now, it does make a difference whether we consolidate and invest or whether we invest locally. We cannot think that anyway GBP, you are going to invest only in London, either way, because the interest rate is different based on the amount which we are investing. So accordingly, we will have to look at it. So now, if you consolidate and invest, let's see what happens. You have surplus amount in local currency. Convert euros to GBP. Because if you are investing in London, everything has to be GBP. Convert euros to GBP. What is the amount? Next, convert CHF to GBP. What is the amount? The entire amount will be invested in UK. Now, when you look at the problem, you find that based on the amount invested, the interest keeps changing. This is why we said it is relevant, because the interest amount you get is different when you invest only the surplus amount in London. When you convert the surplus amount in the other two centers, so into GBP and so annual interest rate we need for 3 months. So what is the interest amount? So how much will be the investment receipt? This is the investment receipt, but the surplus money is available only for 90 days. Therefore, in 3 months' time, you need to return the principal amount. That is, the 7,25,000 has to be returned to Amsterdam. Then 998,077 has to be returned to Switzerland. So the GBP outflow for this repayment has to be deducted, and the balance will be the amount available. So now, next we will convert. We have to return CHF. Therefore, the investment receipts which we have got in GBP, to the extent it is required to return, we will convert. As far as UK is concerned, it is already in GBP only, and you have to return in GBP. So what is the total GBP outflow to return the principal? The investment receipts you have got is 1013,525. The outflow is 1008,851. So you have got an interest of 4673 GBP. When you invest locally, it is only 3277. So the question is whether there is an advantage of swapping euros and CHF into sterling. Yes, you do have an advantage of swapping euros and CHF into sterling. And that results in an incremental benefit of 1,446 GBP. So have you completed? Are you comfortable? So that brings us to the end of our 8-day session. What are the chapters we have done? All the important problem chapters we have done. Your first chapter, Financial Policy and Corporate Strategy, it's an all theory chapter. Risk management is mostly theory. You may get value at risk problems. Advanced capital budgeting, we did, and I told you, see all these 8 sessions, we have done the most important 8 problem chapters. Advanced capital budgeting, you definitely can expect a question because that has been included in the final curriculum only now. Now, security analysis is predominantly theory, and security valuation, we did bond valuation and equity valuation. Portfolio management, again, we did problems in portfolio management. Securitization is a fully theory chapter. Please do that. Mutual funds, we did problems. Derivatives, we did problems. Forex exposure and risk management, again, we did problems in that. International financial management is what we did today. And interest rate risk management, you can please go through that. Business valuation, mergers and acquisition, those 2 chapters also we covered. Startup finance, your last chapter, again is an all theory chapter. So I wish you all the best. Let's end the session. Bye.